A lot of you are typing in how to calculate return on real estate investment. My favorite thing to do when looking at a deal is to evaluate it properly because that's where all of my revenue lives. If you calculate a deal incorrectly, it'll cost you thousands and thousands of dollars later. In fact, evaluating deals incorrectly is the number one thing that kills deals after you buy them. In this video, I'm going to walk you through the 5 things you need to know to calculate your return on investment in a real estate deal. Before you do that, you have to understand how it's at play and then the ultimate formula for really deciding that return. Because we don't buy real estate emotionally. We buy it on data, meaning the numbers tell us if it's a good investment. And stick around to the end because I have a free gift I want to give you that'll help you completely revolutionize your real estate portfolio. The first thing you want to know when evaluating the deal is what market you're buying in. This is a big thing. A lot of people don't play into their evaluation process. They look at the numbers and they look how it looks on paper, but they don't think about the market. This can actually be the number one thing that makes you money. And here's why. You buy a property in Iowa where nobody lives and there's cornfields everywhere, you're going to appreciate a tad slower than if you buy it in Atlanta, one of the fastest growing cities in the country. Because jobs dictate real estate growth. Underline that one because let me tell you, it'll make you more money than any other truth. Your market will dictate your growth of value. And the growth of value is where the majority of our profit lives in real estate. Yes, we love cash flow, but appreciation will always make you more money. In fact, we say it this way. A lot of people see cash flow as cake and appreciation as icing. That's the wrong way to look at it. Appreciation is our cake, cash flow is icing. Because you'll always make more in appreciation than you will cash flow. What drives appreciation? Right here, the market. Yes, we can increase the value by increasing our income, but you can only do that so much if the market is declining. So before I buy a property, one of the things I look at is I go to Google and I see where the population at. Is the population growing or are we seeing a dying city? Somebody texted me a while back asking if I would invest in Cleveland, Ohio. The answer? No, because it's been a declining city for many, many years. Now, if somebody asked me, will you invest in Columbus, Ohio? Absolutely, because Columbus hasn't dropped in population in over 20 years. It has been a consistent growth track. Would I invest in Indianapolis? Absolutely. Last year, Indianapolis had the strongest rent growth of any city in the country. The thing is, the market dictates value. And if you want to see your ROI skyrocket, make sure you're buying in a market that'll let that happen. But then the second thing when you're evaluating a deal, you obviously have to look at the financials. That's kind of a no-brainer in the investment world. We have to see where the financials are. So we have to look at our income and expenses and see what our NOI is. NOI is simply income minus expenses equals your NOI. So if you do income minus expenses, you're going to equal your NOI or your net operating income. The bank and appraisers will dictate the value of the building off of your net operating income. So in commercial real estate, for example, if you're increasing your NOI, you actually increase the value of the building. You increase the value of the building when this number goes up. So when you're looking at a property, should I buy this? Should I not? Is there room to take the income up? If the income is already at the top of the market and there's really nowhere to go, might want to look for a different property. Income minus expenses is your NOI. We need to know that number in order to calculate our return on investment. You'll see why later. And then, of course, the third thing you need to know is your cash needed. This is how much money is it going to take to get this deal to the finish line. And here's what comes into play when you're thinking about your cash needed. Number one, you have your DP or your down payment. This is by far your biggest expense of any real estate deal. You need to make sure you can cover the down payment, and usually that's anywhere from 25 to 40% of the asking price. And that range is dictated on the value of the property and the stability of the property. If it's bleeding cash and it's not really making any money, they're going to want you to put more money down. If it's a really good stabilized property and it's making good money, they're willing to take a little bit more risk and put in 3/4 of the investment. So the first thing you have is your down payment. Then you have an appraisal. So you have to go and get an appraisal. An appraisal is going to cost anywhere from $2,000 to $7,000 depending on the project and what kind of appraisal you're getting. So you're going to need to cover the appraisal in order to get that deal done. You're also going to have to cover an inspection cost for every property, forever, to get an inspection. And here's why I make such a big deal about inspections. Number one, when you pay an inspector, their job is to find something wrong with the property. They feel like if they hand you an inspection report and they don't tell you anything, that they really haven't done their job. So they're going to find something. You take that inspection report back to the seller and you say, listen, here's the things that need to be fixed. Would you please either fix these or decrease the cost of the property? And this often, almost every single time, you'll get your cost of inspection back in either a decreased price or the owner doing some work for you. We recently bought a building and we got an inspection on it. The roof was a little iffy. We asked for $20,000 off. They ended up taking $10,000 off, but it was an $1,800 inspection. That's almost 5x our investment of an inspection by getting that inspector to look at the entire property, and it brought our cost down $10,000. That's the value of an inspection. I know it costs money, but I would encourage everybody to get an inspection. Even if you're a contractor, I would still get a third-party inspection because you have bias in the property, and the seller may not be as apt to work with your inspection of the property, but a third party who has no bias in the deal, they're often seen as more truthful and more honest in the inspection. And then the fourth thing you're going to do is the closing cost. The closing costs are anywhere from 0.5% to 1.5% depending on the kind of bank you're using and the kind of loan you're getting. So make sure that you count the closing costs so you understand where really am I at in my cash needed. So if you write down your down payment, your appraisal, your inspection, your closing costs, then you're going to have the majority of the cash needed. Now, there are some stipulations to the cash needed depending on the kind of deal you're doing and how you're structuring it. If you're buying it with other partners, you may have some legal fees, meaning you may have to drop a JV contract or a syndication contract. Now, if you're drawing up a syndication contract, that can be anywhere from $7,000 to $15,000. So make sure you know if you're drawing up a syndication contract and a PPM or a private placement memorandum, you need to know that that's going to increase your cash needed to get into a deal. And the last thing you really want to know that is only applied to really bigger buildings is if it's a bigger building, the utility company may ask for a utility deposit and the insurance company may ask for your first year's insurance paid up front. Well, first year insurance paid up front is a lot of money on a bigger property. It can be anywhere from $50,000 to $100,000. And so you want to make sure if that truly is the case that you prepare for that cash needed. The reason cash needed is so important is this is what dictates our return on investment. How much money we have to put into the deal to get it will dictate how much money we're actually going to make on it. And that's why the cash needed is such an important process to go through and figure out how much you actually need to get into this deal. Before I go into the last two tips on how to figure out the ROI of any real estate investment, make sure you subscribe to our channel and join our family of real estate investors that are creating financial freedom through real estate investing. Also, make sure you smash that thumbs up button and hit the bell notification so you get notified every single time we do a video. And the fourth thing you need to calculate is your value add. Now, your value add is how you're going to increase that number. Value add is how we're going to increase the net operating income. So are we going to increase income? Are we going to decrease expenses? And how is that going to happen? Maybe you've really looked at it and the rents are 10% low and you can really raise the rents. No matter if it's a commercial piece of real estate, storage units, mobile home parks, or multifamily, you can increase that NOI. But your value add is a direct correlation to how much we can increase the NOI, meaning either increase the income or decrease the expenses. And so what you want to do when you're evaluating a property is start figuring out what your value add is. One of the ways I do that is you can go to a company called rentometer.com and you can check the rents in the area and kind of see the average of the kind of property you're seeking to rent out. That'll tell you an average, and then you can dictate if you can go a little bit higher because your building's a little nicer, or you need to come down a little bit less because the part of town you're in or the kind of property you have may not be able to yield what the market is getting. But that process will help you kind of see the average in the area. Now let me make sure I make a note again about the average. The average doesn't mean that's all you can get. It just means that takes into account the entire area of both the low rents and the high rents, and it gives you an average. I've realized the averages are usually low for the properties I have, and so we can bump that up a little bit more. So if you have a 1-bedroom, 1-bath, you're getting $750. You look at the market, it's getting more like $850. That's a lot of value add. So you can put $100 per unit. So if we do $100 per unit on a 10-unit building, that's $1,000. So that's $12,000 per year. So we just increased our NOI by $12,000, assuming we don't decrease the expenses at all. When you're looking for a property, looking for properties that have value add components should be one of the number one things you're looking for after you pick a strong market. If you're in a good market, that could still be okay because that market's going to continue to grow and increase the value of your property, but it's going to take longer usually. So buying a property that has value add components, they have low rents, or they don't have any other streams of income that are possible, then that's a value add opportunity and we can go forward with that. And the fifth thing to evaluate when you're looking at a property is your cash on cash return. By the way, your cash on cash return is your ROI, at least while you own the property. So cash on cash return is simply a simple formula. NR divided by CN equals your ROI, or your cash on cash return. Now, cash on cash return simply means how much money do I make in relationship to how much money I have to put into the deal. So let me walk you through this formula. NR stands for net return. So I take my income minus my expenses, I get my NOI. This does not include my mortgage payment. So then I minus out my mortgage payment and I have my net return. So all a net return is NOI minus mortgage payment. Now I have net return. So here's how this net return works. So you take your net return, that's how much you make after all of your expenses, all of your mortgage payment. It's how much you have left every single month after everything is paid. That's your net return. And then you divide that between your CN, or your cash needed. So let's say you needed to put $100,000 into a deal to get that deal done. So we have $100,000 is our cash needed. And let's say we make $9,000 a year in net return. Well, if I do this and I go 9,000 divided by 100,000, I'm going to get a 9% cash on cash return while I own the property. And what this does is helps you, number one, speak to your investors educatedly if you're raising money, or if you're doing this project yourself, you'll begin to know I'm starting off making 9% on my money. It's going to be more than the stock market, but it's not a massive return. So then you can decide, is this a big enough return to get me into this property? And that's a personal decision. But this is how you calculate it. After you know your NOI, you take out your mortgage payment, you have your net return. You take your net return and you divide it between your cash needed, and guess what you have? You have your cash on cash return. Now, this is applied only when you own the property. See, this does not apply if you sell the property. If you sell the property, this number will go up because you'll make more money. But what I want you to know is how much money you're making while you own the property, because your exit strategy may be different. Maybe you want to refinance the property and hold the property long term. Well, then you know your cash on cash return. If you sell it, this number is just going to skyrocket. And I also want to give you a free gift today. For tuning in today, I want to give you my free multifamily masterclass that walks you through the 5 ways to bust into the multifamily market without having any money of your own, and you can even do so in 10 weeks or less. Click the link in the description and go to freemultifamilymasterclass.com and get our free training to really help you start getting real estate right away.